My name is Jake, welcome to the channel. In today's video, we're going to talk about market cycles, and I'm going to share with you a few of the things that I think about as a regular person, as a regular retail investor, and what I think about on the topic of market cycles. I'm going to share some detailed information, some things that I'm thinking about, as well as I'm going to share some resources that you can use to better educate yourself on market cycles and really learn from those people that really know what they're talking about and that have years and years, decades of experience on the topic. Before we dive into today's video, I want to give a very brief update on Julie. Julie has, if you watched my last video, it was all about donating to help Julie, my wife's friend, escape or leave Ukraine and go into Poland. And so if you haven't watched that video, it was all about that topic of helping and donating to Julie and her family. I wanted to give a very brief update that Julie is safe, that she did make it into Poland. She is in the capital of Poland in Warsaw, and that still it's a very fluid situation, but I just wanted to thank every single one of you that did end up donating to help Julie and her family. I wanted to transfer the money over to her, everything that was donated today in this video, but I just realized that today is Sunday and you can't do a wire transfer on a Sunday. So I will be transferring just over $2,000 that we brought together here to donate to Julie, and I will be doing that here tomorrow. So wanted to give a huge shout out. Thank you to every single one of you who did end up donating and supporting Julie and her family. So now when we think about market cycles, I think it's important that you understand that if you're just a normal investor, the audience for this video is your normal person that doesn't maybe have a finance or an economics background, that really should understand the basics when it comes to market cycles. The key message that I want to get across is that timing the market is incredibly difficult, and we're going to talk a little bit about why that is and why dollar cost averaging is the best approach for your average investor. Your average investor who really doesn't have any insider knowledge about what's going on. Maybe you're not Pelosi, you don't have insider knowledge on what's going on in the market. You're just an average Joe. This video is for you to help you kind of understand that you can't time the market and that dollar cost averaging is probably going to be your best bet, and dollar cost averaging into high quality investments, whether those investments, whether they be businesses or ETFs. So that's the key message of this video. And if you're interested in learning more, I'd invite you to stick around because we're going to talk about exactly that. Now, if you've been watching my channel, you probably have heard me say 1,000 times that past performance is never a guarantee of future performance. That is absolutely true. It's important to understand that the market is fluid. It's always changing. Things are going up and things are going down. And if you're a normal investor and you're trying to time Mr. Market, that is going to be incredibly difficult. Companies that are doing great today are not necessarily by default going to be doing great tomorrow, or in 10 years, or in 20 years. If you look at the S&P 500, the first year that the S&P 500 was created, the top companies in the S&P 500 were General Motors, Exxon, Ford, US Steel, General Electric, etc., etc. Could you imagine in 2022 that AT&T would be in the top 10 in the S&P 500? You think of that and you just kind of laugh. You just like chuckle, like, what? No, of course not. The market is always changing, but I'm positive that if you had a regular investor back in 1957 looking at the top 10 companies, knowing what he or she knew back then, they would have thought, yeah, these are the best companies in the world. They're going to be around forever. But the reality is that that's not always the case. And so if you look at the Dow Jones back from when the Dow Jones was created back in the late 1800s, the companies here on this list, the majority of you have probably never heard of except for General Electric. Back in the 1800s, I could just imagine, you got this regular old Joe saying, oh, American sugar or American cotton oil is going to be the best investment for a lifetime. It's just like, no. Fast forward a couple of years, half of these companies are not even, the key message that I want to get across here is just because a company is doing well today, it doesn't necessarily mean that this company is going to maintain a competitive moat. And so it's important that you don't get lost in the now and thinking that what's working today will always be working in the future, because it doesn't work that way. Because a lot of these companies on here are just memories and nothing more. And so if you think about it, some of these companies, US Leather Preferred liquidated in 1952, right? Now, US Leather is just a memory, kind of like my childhood growing up in the 1990s. It looked a little like this.
Welcome. You've got mail.
I did not have.
Yeah, baby. Yeah.
Oh my gosh. Oh, good times. All right. So when we think about market cycles, one of the best videos out there that I think anyone could ever watch is by Ray Dalio. It's How the Economic Machine Works in 30 Minutes. If you want to continue learning about how the economic machine works and how market cycles really works, and you want to learn it from the best of the best, I highly encourage you, take 30 minutes and watch this video. It's really informative, and it helps just your average person understand how the economy works, why the market reacts in a certain way, and why things happen the way that they do. And there's a pattern to it. And there's a short clip that I want to share from this video where he talks about the short-term debt cycle. And I think this is something that we're all going to be seeing here in 2022 as the Federal Reserve is going to be increasing interest rates, and what kind of impact that will have here on the economy, not only this year, but for years to come.
As you can see, the economy works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature. Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle.
So the key takeaway for me from this video was really understanding short and long-term debt cycles, and really the impact that the Federal Reserve has on our economy. Whether that be real or artificial, it does have a real fundamental impact on the way that the economy operates and functions. And once again, I can't recommend it enough. If you want to learn more about market cycles, highly recommend watching this video. Something that I thought was really interesting is when you think about the S&P 500 back in the 1950s, and you think about it here in the 2000s, that companies are innovating and productivity is going up, and it's getting faster and faster. And that's, not to spoil that video from Ray Dalio, but really it talks about productivity. If productivity increases, then we're in a boom. If productivity does not increase, that's when bad things happen. But one of the things that's so great about our economy, I can't speak for the whole world, but here in the US, is how fiercely innovative we are as a society. And we're always trying to do better. We're always trying to do better, and productivity continues to increase. And because of that, some companies get left behind. And so with that, you see that there's projections that the S&P 500 here in the past, the heavyweights, the big S&P 500 companies would be in that index for about 33 years. But looking forward over the next decade, due to productivity increases or decreases, depending on which side of the aisle you're on, that is actually forecasted to drop from 33 years of being in the index down to 14 years to being into the index. And that really, if you own the index, If you're a boglehead investor and if you own the index, that's actually a good thing. As one company rises, one falls, and one replaces it. And it's self-cleansing. As you as the investor, if you do invest into an index like the S&P 500, you are benefiting from the American economic machine. Now, this is just another way to visualize this. Over the last 200 years, I thought that this was fascinating. It is so interesting to see how the market was so different back in the 1800s, the 1900s, and now here in the 2000s, that transport and finance were really the bulk of the economy back in the 1800s. And then you see in the 1900s, you see energy come up, you see healthcare start to come up in the 1990s, you see this shift away from transports into more technology, communication, consumers, just this consumer-driven economy. And it's just so incredible to me to see that I don't believe anyone in time could have predicted this. And if you're a long-term investor, you really can't deny this, that the economy will look different 100 years from now. And if you're looking to build generational wealth, this is something that you cannot just forget about. When I think about, here in the next 10, 20, 30, 50, 100 years, I think to myself, well, what innovations, what disruption could come, right? I think there's going to be a lot of things when it comes to robotics. The whole Cathie Wood themed stocks, I really believe that she's onto something. She might be a little ahead of her time, but I think that theme around robotics, around space, around space exploration, and all of those other things, that the world will look so different in 100 years that you and I, it's really hard to even, unless you're Elon Musk, right? And it's hard to kind of fathom what the market, what the world will look like in 100 years. And if you're looking to build generational wealth, it's important that you understand that. And so if you're investing into individual stocks, you really have to maybe consider, okay, where does that fit into? How does this fit into your overall investing strategy? And something that I find just absolutely fascinating is how every industry is performing different year over year. Just looking at, for example, energy. If you would have told me energy back in 2018 was going to be the highest performing sector here in 2021, I probably would have laughed at you. I think the only people investing in energy prior to 2021 were boomers and maybe, somebody that worked in the energy sector themselves. That was their day job and they understood it. Apart from that, I can't really see why anybody would be all in on energy. Right? What's been working these last 10, 15 years has really been technology. Technology has done very well. Consumer discretionary has done very well. Healthcare has done very well. Consumer staples. And the thing that you have to understand is it is incredibly difficult to pick year over year which sector is going to be the top performing year over year, because the market is always changing. And this can be due to, micro or macro level things. This could be geopolitical. This could be, there's a huge array of things that could be going on in the economy at that given time. But that's the key thing, is you never know. Because every single time something happens, it's the first time that it's ever happened. And that is actually something that Ray Dalio was talking about in his video that I was just mentioning, that though he's been investing in the stock market for 5 decades, 50 years, that he still gets surprised by something new every time. There's always going to be a first. I mentioned at the beginning of the video that your average person is better off not trying to time the market, but rather to dollar cost average into their portfolio. This is really the best case for most people out there. If you look at the S&P 500 index over the last 90 years, yeah, there's been a few pullbacks, but I guarantee you that the majority of you watching this video were not able to predict when the right time was to get out of the market and to get back into the market. And so if you understand that, focusing on what you can control and dollar cost averaging into your portfolio is one of the best things that your average person can do. And we can't forget about inflation. Inflation is that silent killer that's happening in the background. It's eroding your purchasing power. because of inflation, your purchasing power is going to go down. There's only a few things that I know for sure in this world. It's one, that there's always going to be taxes, there's going to be death, and that inflation is real. I think there's a lot of other truths in this world, but I think those three are the most fundamental, and there's really not getting around it. Everyone's going to die one way or another. Everyone's going to have to pay taxes one way or another, and everyone is going to be impacted by inflation. Those are the three truths, and I think it is so important. You can't let this out of your sight. You have to understand that inflation is real. Over the last year or so, this has been more evident because the inflation rate has gone up dramatically. And if you do watch that video from Ray Dalio, How the Economic Machine Works, he does talk about inflation and the Federal Reserve's role in managing inflation and how it does impact the economy. So if this video hasn't scared you out of investing into individual stocks and you still want to invest into individual companies, I think a great way to start is focusing on this coveted status called the Dividend Aristocrat. So if you're not familiar with the Dividend Aristocrat, it's a company that has raised its dividend consecutively for the last 25 years. And these are really the cream of the crop when it comes to companies, individual companies that have raised their dividend and have been very rewarding to shareholders over the long term. Now, I personally don't just go and only invest into companies that are, that meet this status of Dividend Aristocrat, but I think it is a great place to start, especially if you're a new investor and you're building out your portfolio and you want to have a mixture of ETFs and individual companies. I think this is a great place to start to look for companies that have a great track record of dividend increases, though it is never a guarantee that they will continue to increase and raise their dividend. But I think the key thing here is this is a great place to start, is looking at these companies if you're going to consider investing in individual stocks and you're building out a dividend portfolio. Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you learned something new. If you want to learn more about market cycles and you want to understand how the economic machine works, I would highly encourage you watch this video from Ray Dalio, because it will really open your mind and your eyes to how the economy works and how inflation, how interest rates, how the Federal Reserve, how all of this, how the debt, short and long-term debt cycles work, and how this will impact the economy. And really, I hope that it will inspire you to think long-term, not time the market, and think as a long-term investor. That's the key thing. Thank you so much for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.